Hello, I'm Darius McDermott from Chelsea Financial Services. Going to have a little chat today about outlook for 2026, but also a little review of what's gone on in 2025. This has been a very interesting investing year. The real sort of market wobble was all around Liberation Day and Donald Trump's announcements. That said, looking back, markets appear to have completely ignored the sort of potential impacts, and it's been a very strong year for global markets. For once, it's not just been the US. There's been very strong performance in UK, Europe, Japan, and Asia and emerging markets, mostly led this year by China and not India, as it has been in previous years. So really strong returns, and that is very welcome for all investors. 2026 gives, of course, different challenges. I think on recording views this time last year, we would have said US equities looked expensive. They have also had a very good year, and it's impossible, I think, to argue that US equities as a whole are cheap. A new phrase that's grown in the last few years, of course, is the Mag 7. I think even grouping those set of companies together is probably incorrect, as some of them actually are not super expensive, but the Mag 7 on a forward PE are roughly on a PE of 34 times, which historically isn't cheap, but I think I could argue is also not in bubble territory that we saw around the TMT boom and bust at the start of this century. There are, of course, risks. The tariffs are not yet fully in place, although agreed in most geographies. There's still geopolitical risk. And of course, you've got that valuation having had really quite a strong bull market globally now since the negative year in 2022. Inflation is still a bit of a worry. You know, if inflation persists, it makes it harder for central banks to cut rates. Cutting rates makes us all feel a little bit better off and more likely to spend and consume. So I think those are a few things that we probably want to be aware of. So what have we been doing in the VT Chelsea funds? Well, of course, there's 4 funds and they are all slightly different. Our income fund continues to perform well, but has that income mandate. So a number of growth assets that we have in other funds, particularly gold, which has been spectacular, we don't hold in the income fund as it doesn't yield. We do have a small amount of non-yielding investments in the income fund, but basically everything we buy has to have some yield, hopefully a growing yield or a higher yield. The first 6 months of the year were very strong and outperformance was really noticeable, primarily because we have a number of alternative assets and are not overweight US equities, which did, as I say, perform very badly during that tariff uncertainty period in early April. Then as markets have sort of rebounded, particularly again in the US, led by a number of hyperscalers tech stocks, we do have exposure to those areas, absolutely we do, but I would never think that they are going to be the only driver in a multi-asset portfolio as we sit here, primarily as UK investors. So what do we sort of like for 2026? And I think this is a generic take, but also you might expect that these are things that we have been increasing our weighting on across the VT funds. Emerging markets is an area which we have been adding to recently. China's had a very strong performance year, and we have managed to capture a little bit of that. But what I think Liberation Day showed, not just to UK investors, but investors globally, was maybe you do need some diversification, particularly away from S&P, where those 7 stocks now are almost 40% of the index. So you think S&P 500 is a broad index. It is, but 7 stocks is 40%, and they are all quite heavily correlated. So having other exposures for diversification is an obvious thing. Another area we've been adding to, and this definitely sounds a little repetitive from the last few years, but UK small and mid caps. Whilst the UK stock market at a headline rate has been very strong, UK small and mid caps have lagged the larger companies and we have been adding to those. So UK, I think, is also an interesting area. It's had 3 really strong years, but is only sort of fair value versus its own long-term history, and is still extremely cheap relative to other areas. But the UK stock market's also very different. We have pharmaceuticals, we have financials, we have oil and gas, we have materials, not areas that dominate the often loved US markets. So yes, we have exposure and will continue to have so, but we have sort of been broadening some of our exposures to emerging markets, adding to UK, and we've even been adding to areas like frontier markets, which are hugely diversified markets in aggregate away from the world indices.